We've got easy money all around the world, not only the Fed, but also in Europe, Eurozone, and Japan. And Japan's been a big entrant into that and really aggressive with their monetary policy with a very popular leader.
So do valuations not, counter into a decision on when to put money into equities right now? Do you worry about valuations, even though this market is going up on all of this easy money, as you say?
Yeah, valuations are high, particularly in small caps and in some of the consumer cyclicals, but there are still areas for relative value, and I think there's still room for further margin expansion as we look forward into the future, driven by the Fed policy and keeping the asset bubble going.
Nathan, how do you see it?
The way I see it right now is that we're in sort of a trading range and we don't know where to go. We're range bound. Most rallies start at about 11 on a PE and they end or die at around 19 or 20. So when you sit at 16 or 17, the hard part for everybody is that we're halfway between where we've been and where we're likely to go. And when absent news, like we saw, well, you didn't have any great news today, so everybody looks around and now's the time to check your strategy. And I think if you don't have enough in equities, now's the time to think about it. But watch the party over in Europe. I like VGK as an example, because when you hear the Draghi announce in a couple of days they're dropping rates from 0.5% to 0.25%, there's only one more thing we need to hear, and that is that it's going to be a short-term emergency measure like our Fed for 5 years, in which case then you'll know it's really time to get out the party streamers.
So is that what you're expecting? You think rates go even lower in Europe then?
Yeah, I think
meeting this week?
Absolutely, Maria. They go to a quarter, and they're going to stay there for a while. And we've seen the movie, we read the book, we got the T-shirt, we got the postcards from our friends. We know what happens in Europe when money gets down to a quarter point and stays there for a while on bank funds.
Interesting. Tim Leach, where are you on all of this? I mean, we've got a big meeting on this week for the ECB. There's speculation we could actually see rates go lower. What's your take on that? How does that impact markets?
Well, I think rates have to go lower in Europe, Maria, with the core CPI in Europe below 1%, 0.8%. Europe is very much in danger of a deflationary risk, and they really have to counter that very strongly. But here at home, when we think about the easy money policies that our Fed has been maintaining, and I agree with the first guest in the sense that it's hard to fight that or to see that that's going to choke off the equity market returns. But the issue that we're actually seeing now on the horizon, Maria, is that the Fed may surprise. The Fed may actually look at the January meeting, but probably more certainly for the March meeting, if not January, in order to begin the taper. And that may catch some people by surprise.
Yeah. What do you think happened today? Samir Saman, I want to welcome into the conversation from Wells Fargo Advisors. No catalyst, Samir, that you could point to today? It felt like a quiet day on the street. What were driving things from your standpoint?
Probably the most interesting thing going on today is you had the dollar down, but you also had commodities down, and that usually doesn't happen a whole lot, and you've seen that over the last few weeks. And one of the reasons for that is, the Fed policy this time around is keeping asset prices actually fairly low. And so I would take the other side. You could see the Fed staying on hold much longer because there's a lot of room for them to really keep from tapering. And so in our opinion, the stock market could continue to run for a little while longer.
Yeah, it's interesting.
Maria, what you're seeing, though, with the bond market, by virtue of the fact that they won't let the 10-year get below about 2.6 right now, is they're saying, you know something, we're going to do better next quarter. And if the economy can get along and you can add 2 points to a 2.6 and get a home mortgage at 4.6 and the wheels don't fall off, they're not about to give away anything at this point on the bond market. And I think that's why rates have stayed, other than when the politicians mess things around in the middle of October. If you take a look at the chart, we're sitting at 2.6, and I think the bond market says we're not going any lower than that.